Will the conditions ever return that favor equity long short, or is that kind of, has technology and the evolution of financial markets made it a dead-end strategy?
We hope so, for the sake of active managers in the industry. But again, where is the information edge? That pre-Reg FD, and then you had the information networks that the SEC eventually eliminated because of a few bad actors, but you had some degree of information edge. Now that's non-existent. That's point one. Point two, and people forget about this, someone else with deep pockets has to drive a security price in your favor for you to make money from a stock selection. That used to be the long-only active management community. They're a shadow of what they once were. At some point that could turn, but when? 2 years from now? 5 years from now? So
all that capital's been soaked up by passive instruments.
By passive, and so there's no final arbiter of idiosyncratic risk. So again, we're hopeful, but we don't expect
Makes markets less efficient.
In theory, idiosyncratic risk should become a large enough determinant. So instead of 5 or 10%, 20 to 30. But when? And then again, who drives the stock either up or down in your favor? You need a deep-pocketed, active manager that's looking at the same things you are.
So what do you like?
Yeah, so look, I think two of the themes that are recurring here at SALT are if you can find things that can profit from regulatory relief that you're fairly certain you're going to get, that's one. And then geographically, there seems to be enthusiasm for Europe, which we share with the cautions that always come around Europe. So I'll start with regulatory reform. One of the few things that everyone agrees in Washington, and there's very few, right? Whether it's Republican, Democrat, Senate, House, Trump, White House, regulators, politicians, is that the regional banks, community banks are overregulated, right? They need
a little more room to breathe.
They need a little room to breathe. And what makes sense for Bank of America or Citi does not make sense for Zions Bank, for instance. So that, to the credit of the Obama administration, they were already moving in that direction, and that is it's already been accelerated, will accelerate further. So the question is, how do you play that?
Yes,
we think,
for you,
yeah,
that is a good question.
We think we like things that have maybe less upside if everything goes right, but less downside if things go wrong. And so if you can play the CDOs of trust preferred securities that are backed by those banks, we think you have meaningful upside with less downside than, say, playing the KRE or various bank indices. So we like that, and that, again, fits in a broader theme of regulatory relief that you're fairly certain you're going to get. The second would be Europe. So, Europe, it's Europe. Don't forget that. So disappointment is part of investing in Europe. But Europe's been either a galactic disappointment or a disaster since 2010.
Yes.
You're finally in a situation where you have good economic growth, actually better than the U.S. the past 2 quarters, for what it's worth, better inflation data, and QE still in play, reasonable valuation discounts, and last but not least is flows. So you had over $200 billion pulled out of Europe the past several years, and you finally stabilized and turned up. So we step back. We're not making a wild beta bet or anything like that. We're just saying that if ever there was a time for Europe to outperform the U.S., it's probably the next 6 to 12 months.